Is the Fed spearheading the crash of the U.S. economy? Will Jerome Powell, Federal Reserve Chair, be the main reason why you and your family are broke, poor, in poverty, have little to no money in savings, and will just be lucky to have a job where you're making barely enough money to be broke, living on the streets, in your car, truck, or van, or possibly even being homeless? Well, in a report by CNBC, the Fed has increased interest rates 7 times already and are willing to increase the rates even further. I'm afraid the answers to these questions and many more to follow are all bad news for those who are not prepared and are not well insulated and feeling the cold weather and devastating effects of record high inflation, higher prices at grocery stores, gas pumps, price increases pretty much all across the board, and now a potential likelihood of job loss and mass unemployment. Oh, and taxes. Yes, some may be eyeing a nice little return from the IRS for all the overpayments that they made from each paycheck last year, extra money that could have really come in handy then, more so than a year later after April 15th. But for many of these H&R Block, TurboTax, and Jackson Hewitt tax return recipients, that money is already spent and is earmarked for overdue bills and past late payments to keep the lights on or prevent your car from being towed away and repossessed. Here, take a look at some of these comments from fellow YouTube viewers. The Fed isn't predicting it, they are making it happen. And as a non-homeowner, I can hardly wait for this crash/correction. Large grinning yellow emoji face. And this one, I'm a product developer, and even in my line of work, we are seeing how various projects are affected due to the economy. It's always scary. I will say that your videos have really helped me in the preparation of what's to come. Well, thank you so much for that. I try my best to bring you guys what matters to you most. So the Federal Reserve recently announced the 7th consecutive increase to the federal funds rate and indicated its intent to continue raising interest rates going forward. The Fed has repeatedly raised rates this year in an effort to corral rampant inflation that has reached 40-year highs. However, there are meager signs inflation is starting to cool. While the idea of higher interest rates may help curb soaring prices, it is important to point out the fact that it also increases the cost of borrowing, which can make everyday financial products more expensive, like mortgages, personal loans, and credit cards. And given the current economic outlook and interest rate environment, saving money and paying down high interest debt have become more appealing for many Americans at risk of total economic collapse and, unfortunately, in fear and panic-stricken by inflation, the looming recession, anxiety induced from the possibility of being on the brink, the cusp of a depression. So comment down below and tell me, folks, what do you think you should do with your money after the Fed's interest rate hike? And spoiler alert, the answer to this question could make or break your family balance sheet and possibility of preparedness and sustained future survival. Hello, everyone, and welcome. And I just want to thank you all for joining in on your daily dose of the truth about what matters to you most. And if you're new to the channel, well, my name is Kevin. And on my channel, we discuss, investigate, plan, and prepare for all things finance, money, economy, savings, investing, building wealth, building businesses, building YouTube channels, and other monetized income streams, diverse income opportunities, passive income, CBDC, central bank digital currency, cryptocurrency, Bitcoin, BTC, Ripple, XRP, ETH, Ethereum, real estate, mortgage rates, the housing market, retirement, the stock market, inflation, looming recession, and so much more. All your likes, shares, and comments help the channel immensely and will help me in continuing my research, investigating the important facts, and uncovering the truth for all of you. In addition to providing you with loads of information and tons of value to help you improve your finances, save more money, achieve greater returns on your investments, increase your income, and build out multiple and diverse active income streams on the way to securing solid, long-lasting passive income streams. So please make sure to hit that like button and subscribe to the channel and help me reach the goal of gaining 75,000 subscribers. Thank you all so much. You're all so very important because without any of you, none of this would be possible. And folks, for anyone and everyone who's been asking about how I protect, secure, and diversify my assets and investment portfolio, I want to share that I continue to diversify my portfolio and my investments because you just never know what they're going to do to us next. The days of the dollar as we once knew it are numbered, and the new CBDC, central bank digital currency, will be here before you know it. And I want to make sure I have options. I hope that you're all doing the same. So I have included a list of 100% free links down in the description with helpful tools that can begin to put you on the path to financial freedom and eliminating debt to secure the future economic state of your household balance sheets and prepare to protect your family in these crazy and challenging economic times. Now, I'll tell you what, I know that I sleep better at night knowing I've made the right choice for me and my family. And with the links that I have provided, they make it very simple and easy to diversify and not only invest in one of the financially strongest precious metals, but more importantly, if you're like millions of other worried and frantic Americans right now looking at this crazy economy and their retirement investment portfolios and wondering what they're going to do now, just remember my 3 pillars: diversity, security, and cash flow. Remember, folks, 100% free links in the description down below. So as the Fed's decision to raise interest rates means it's time to save and pay down debt and do it fast. A complex web of factors influences the economy and interest rates in general, thus making it impossible to predict the future rate environment with absolute certainty. But right now, there are no signs that rates will be dropping anytime soon, and the Fed says it will continue rate hikes in 2023. And even if the economic outlook suddenly shifts, it's always a good idea to focus on the fundamentals that put you on a firm financial footing. So that's why now is a good time to reassess your approach to saving and to take a good hard look at your debt, especially debt with a variable interest rate. So just think back. During the height of the pandemic, the interest you could earn on money held in savings accounts was next to nothing. Even high yield savings accounts often had APYs, annual percentage yields, under 1%. But in a world of high interest rates, savings accounts can earn much more considerable returns. Currently, the best high yield savings accounts offer rates of over 4% with no monthly fees. And at the time of recording, a UFB preferred savings, previously known as UFB Best Savings, their account can earn up to 4.55% APY with no minimum balance and no monthly fees. And it's not the only account offering high returns. High yield savings accounts with Marcus by Goldman Sachs and Lending Club also have APYs of 3% or more. So while savers have reasons to celebrate during an era of high rates, borrowers may feel the pain of increased costs. And if you have debt tied to an adjustable interest rate, you'll pay more for the money you've already borrowed. So one of the best ways to save money during times with high interest rates is to focus on paying down your debt with the highest interest rate first. The balance on your credit card is often a good place to start, as many cards can easily have an annual percentage rate or an APR of more than 20%. That's more than double today's inflation rate and far higher than what you'd earn with a savings account. And that's if you have great credit. For all others with good, poor, and even less than stellar credit, bad credit, and are even capable of securing a credit card with multiple derogatory marks on your credit report, well, I would imagine that your interest rates on borrowed money will be much, much higher. And throwing all your money away to interest payments prevents the ability to save and protect. Most importantly, building an emergency reserve fund as a vital safety net. So building up an emergency fund is a wise decision regardless of the economy's health, because your personal circumstances can take a turn for the worst even if the broader economy is doing well. And although there is debate as to how much you should save in your emergency fund, a good target is to have enough funds to cover 3 to 6 months of living expenses. And keeping your emergency fund in a high yield savings account allows you to earn interest and have your cash work for you. And with record high inflation, climbing savings rates, and rapidly increasing interest rates on debt, all at elevated levels, you may have to balance building your savings with paying down debt at the same time. So as the Federal Reserve is continuing to raise its benchmark interest rate, that just means that rates for mortgages, personal loans, credit cards, and savings accounts are likely to continue increasing respectively. And although there are signs that the pace of the increase in rates may be slowing, the Fed hasn't signaled it will stop the rate hikes anytime soon. So with high rates, savings becomes more appealing, and paying off your debt is even more important to me and others who are focused on financial wealth and freedom for years to come. And so now we must ask the question of, what does this mean for the U.S. economy? I mean, first of all, we see that the housing market is at its all-time high, higher than the peak of the 2008 recession, says the Entrepreneur, with the median priced home now costing 42.9% of an American's average income. And this year alone, more than 122,000 employees have lost their employment in major tech companies, laying off their workers by the thousands. So needless to say, consumer debt has reached its all-time high, with more than $1 trillion in consumer debt added in 2022 alone. So what's the way forward in light of all these bad news headlines and terrible consumer finance and business reports? Well, let's see here. Number 1, cutting of unnecessary expenses and costs. Number 2, saving as much cash as you possibly can while you can. And number 3, investing, perhaps considering something like treasury bills and bonds maybe. So I truly hope that you guys find this information helpful, educational, useful, and I look forward to seeing you all back here again on my next video. Thank you all for hitting the like button and helping me reach my goal of gaining 75,000 subscribers soon. All of you helping to share these videos is paying off, and sharing these important updates, the facts, the warning signs, and most importantly, helping others to prepare and gain access to the truth. Now, you all take care and be safe. And until next time, I'm at Kevin247, Kevin Prepper, or just plain old Kevin in all caps. And I'll see you guys real soon. Take care.